You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Michael Page, BHP Billiton, Magnum Ice Cream, JD Sports, Coca-Cola Europacific, and our US listed company of the week is Alibaba. Sam, do you want to kick us off with Michael Page?
Yes, so it's a debut for the show. Anyone who's not familiar with Michael Page, they are basically a recruitment firm. They are FTSE 250 listed, and I think they have been for a while actually, but I think they used to be under the name Page Group. So to be honest, I'd never actually picked them because I didn't know what they did, but they recently rebranded to Michael Page, which I am familiar with. In terms of what the company does, so as mentioned, they're a recruitment company. They do recruitment for over 25 specialized businesses. They're in 34 markets, have 123 offices, 6,000 staff, and they say they've changed over 650,000 lives since 2020. They have come out with their half-year results for the period ended 30 June 2026. Revenue was up 0.1% to just under 800 million, although it was down 1.9% in constant currency. Gross profit was down 1.1% to 385 million, and that was down 2.4% in constant currency. Operating profit was up over 100% from 2.1 to 9.7 million. However, on revenue of nearly 800 million, those are quite small margins. Basic earnings per share was up from nothing to 1.2p a share. Their conversion rate was up from 0.5% to 2.5%. They had improvement and signs of normalization in trading in a number of markets. Approximately 50% of the markets were in growth in the first half. Gross profit per fee earner is at the highest level since 2022 and up 3.7% on the first half of 2025. Net debt is 7.2 million, and that's down from net cash of 10.8 million a year ago. However, that's in line with expectations. And in terms of the outlook, they expect operating profit for the year to be approximately 28 million. For context, their market cap is 697 million. Bear in mind, that's operating profit, not earnings. So that'd be about 24 times. And as part of the CEO's statement, Nicholas Kirk said, "We saw growth in Asia Pacific and the Americas, as well as a return to growth in Q2 in Southern Europe. In total, approximately 50% of the group was in growth in the half. However, trading remained more challenging across France, Northern Europe, and the UK. We have a flexible cost base for our fee earner headcount, which adjusts naturally to market conditions. Alongside this, we continue to control the cost base tightly and have undertaken various programs since the launch of our new strategy to manage the cost base in light of tougher market conditions. These programs included managing our non-operations headcount, moving these functions to more cost-effective locations, consolidating offices, and reducing management layers. Collectively, since the launch of our strategy and excluding savings due to the reduction in fee earner headcount, these initiatives have delivered annualized cost savings of approximately 40 million. This cost-based control has continued in the first half, incurring 2.5 million of one-off costs in relation to some senior exits." If we look at how the company's done over the last 5 years, revenue's basically flat. It did go up and then come back down again. It peaked in 2023. Gross profit, that's the same. That's actually down in 5 years. Operating margin, that's 1.31% for the last full year. That compares to 10.25% in 2021. And the operating profit's gone down as well. In terms of the valuation, they are at a PE of 76. However, the forward PE would be 14. The yield is 3.83%. However, that dividend has been cut. 52% of gross profits Europe, Middle East, and Africa. 20% is the Americas, 17% Asia Pacific, and 11% UK. Michael Page, as a recruiter, I have come across them before. I think they are quite well known and well regarded in the UK, but I don't think there's anything special in these figures that would make me want to have another look. There must be something going on in terms of those figures over the last 5 years. So if I were interested, I would want to drill down into why the market has kind of moved the way it has in the last 5 years. I appreciate there's going to be a degree of cyclicality. It just depends on sort of the market generally. However, there's just nothing really in here that makes me want to drill down on it more. And when the margins are getting worse, yes, that forward PE might be fairly reasonable. But there's plenty of other better businesses. I don't feel like I'd need to spend the time drilling down onto why the last 5 years have been so poor for this business. What about you, John?
Yeah, no, I think similarly, some things that would stand out is that they do seem to have a lot of staff and cost of employment has gone up a lot. The other thing I think is that it's a very cyclical industry, depending on the labour market, something I wouldn't like. And you do wonder how vulnerable they are to AI disruption. They would be my main concerns, and I just wouldn't go any further as a result.
Yeah, so I think on the staff side, and again, I'd have to drill down, you would imagine most recruiters, most of their compensation comes from commission. So I'd have thought that would be relatively okay. In terms of the AI, I don't know. I don't feel like we're that close to kind of being like saying to AI, get me a job. I'm a bit biased in my industry, which is a profession. It's kind of like, well, I've used a recruiter before. They are actually quite useful. Like when I was moving to Leeds, the recruiter was quite useful because where I was previously in the Northeast, I knew all the local firms. I probably wouldn't have needed to use a recruiter. But then I actually found the recruiter very helpful in Leeds because I actually think he did quite a good job. And I know you hear some horror stories about recruiters, but my one did quite a good job. And, I could say, well, this is what I want. This is what I don't want. What kind of firm is this like? What do you think of these guys? And I thought that kind of local knowledge, I don't know if I'd have trusted the AI on that. I think I'd rather have a person that has those relationships with the directors, but that's just one industry out of however many. And like I remember once I was talking to a director of a business and he said that he basically didn't use recruiters. They'd had too many problems with them over the years. They had one woman that they'd hired that was like totally incompetent. And when they asked her why she'd taken the job, she'd said she didn't feel like she was competent for the job, but like the recruiter had told her it was like a sign from God that she should go and do it. Just literally saying whatever it takes to get that commission, regardless of how unsuitable the person might be. So industry wide, it probably has a lot of problems that maybe I don't see as much in my industry. But yeah, just not attractive business anyway, even without those concerns.
Do you think there's an element of how specialised the recruiter is and that AI might disrupt that lower or mid-market area?
I get loads of recruiters adding me on LinkedIn and then sending me basically the same generic message without really seeming to look at my profile. And what you do find is like the more specialized recruiters, you see them around kind of thing. They stay around. Whereas what you find is at that lower level, people will come in, do it for a couple of years and go and do something else. I think probably because they're attracted by the commissions, then find it really difficult because there's just, it's basically at that kind of lower level. I know it sounds horrible because we're talking about people, but it's kind of a homogenous product. Like it's just someone that can come in and do a basic job. And equally, they can be represented by any recruiter. There's nothing, you're not able to differentiate yourself really. So yeah, that lower level, I could see it being a problem, which maybe is the issue for Michael Page, because I don't know what the split is between those specialized recruiters and the lower level.
Yeah.
And I'm kind of just thinking at it from having dealt with, like, because the guy I dealt with, he just did tax placements in practice in the north of England. And that was it. He wouldn't do accounting. He wouldn't do industry. So he was very specialized. But even when I was looking for a recruiter, to actually find one that just specialized in tax was really difficult.
Yeah, no, fair enough. Okay, shall we move on to BHP?
Yes. So I think we're still claiming them as a UK listed company because of their secondary listing in the UK.
I think the primary listing moved to Australia.
But we'll still claim them.
Well, I was going to say, was it 3-4 years ago? Something like that. It may have been a bit longer. So it is a company that I used to own, and this is another one that I'm sad to say I sold it. But anyway, they are the world's largest miner and specifically largest in copper. They had their full year results out last week with full year revenue up 15% to $58.8 billion, with underlying cash profit, EBITDA, rising 27% to $39.9 billion. Performance was driven by higher commodity prices and strong cost control, more than offsetting lower copper volumes. Maintenance and growth CapEx rose 5% to $10.3 billion, and free cash flow rose 83% to $9.8 billion. Net debt fell to $8.7 billion, and that's below the group's $10 to $20 billion target range. A final dividend of 99 cents a share was announced, taking the full year dividend to $1.72. Guidance for the coming year points to a 12% drop in copper production at the midpoint, with limited change to iron ore, and capex is expected to be around $11 billion. And the shares were up 1.3% in early trading. In terms of valuation, the group have a market cap of £179 billion and trade at forward price to book of 3.74, compared with a 10-year average of 2.48, and they have a prospective dividend yield of 3.2%. I think impressive top-line growth here, and they are, I think, probably the best mining company. There have been a number of tailwinds for the group, including an increased demand for copper, which is, as everyone would know, important in power networks, electrification, and in data centers. So you're seeing what's happening in Silicon Valley benefiting the demand for copper, and BHP being a major beneficiary of that. I don't have the figures to hand, but I believe that they have the lowest copper production price in the world. And they are, as I say, the biggest. They've also got iron ore. They've also got potash. So it's not just all copper, but copper is one of their the major driver. They've got very low cost, which, with the tight discipline in terms of cost controls that they're managing, they're a very slick and well-run operation, strong balance sheet, and the copper growth pipeline still looks attractive. Near term, it's lower copper output, and it does require substantial investment in all of their operations, which you see that with the capex expected to be around 11 billion. So these are very large sums. The other thing that with any mining company you need to think about is the cyclicality, and if the demand drops off, they still have a lot of costs. So when times are good, as they have been, times are very good, and when they're bad, they tend to be very bad. But I think with BHP, it's probably the best miner you're going to get, and I think the valuation is fair. I owned the shares, I don't know what it was, probably about 10 years ago, and thought at £8 a share at the time. I think it was maybe around, it re-rated, this is all going all the way back 10 years ago, to maybe 17, 18 times earnings, which I thought was quite expensive. So I sold my BHP at £8 a share, and I think it's now about 35, and you would have had a very decent dividend yield along the way. So anyway, I do have regrets, but I suppose the big question is it a sector that you want to be involved in? I think that's the main thing I would say about it. Sam, what are your thoughts on BHP Billiton?
I think in terms of that price to book, it seems quite expensive. I appreciate the argument about the quality of the business, but again, that yield's low compared to the average. But then at the same time, the share price is at like an all-time high. So I probably don't know enough about mining to actually really give an educated opinion. I did once lose some money on Fresnillo. That put me off really, but because the shares are at an all-time high, it just feels like you're probably buying it towards the top of the cycle. I appreciate with commodity cycles, we don't actually know where the top is a lot of the time, but it would make me nervous. I think if you are going to buy it, you probably want to buy it at a different part of the cycle. But, it's a really, really high quality business. So if you are just going to buy it and hold it, you could probably do a lot worse.
Yeah, I think for me, that was the lesson, that I probably should have just held it through the cycles and, for the long-term trends.
Shall we move on to one that you do hold?
Yes, okay. Just about hold. So Magnum Ice Cream Group, how are they doing?
I think pretty well. So Magnum Ice Cream Group, I'm sure they don't need any introduction, although they are quite a new company. It spun out from Unilever recently, and they have a 21% share of the global ice cream market, with brands including Magnum, Ben & Jerry's, Walls and Cornetto, and they're nearly double the size of their largest competitor, which is Froneri. So they've come out with their half-year results. First half revenue was 4.7 billion euros, and all these figures are in euros, and that compares to 4.6 billion expected. That was up 4.7% on an organic basis, with all regions contributing positively. Volumes rose 2.5%, with higher prices contributing the remainder. EBITDA rose at a slightly slower pace of 3.2% to 900 million, and margins were weighed down by the India acquisition. So in terms of the India acquisition, they acquired a 61.9% in Quality Walls India. And when you look at the brands Quality Walls has, it's basically all about brands Magnum has, but it must have been licensed out to someone else for India. So they bought that back, or they bought a majority stake in it. I think that makes sense. It obviously slots in very nicely because it's exactly the same brands. And I don't think it's a market that you wouldn't want to be in for a company that size. And cost inflation was offset by productivity savings. Free cash flow increased from 138 to 273 million. Net debt rose from 3 to 3.3 billion, but that was largely because of that India acquisition. And for 2026, organic sales growth is still expected to be between 3 and 5%, and underlying cash profit margins are expected to improve by 0.4 to 0.6 percentage points. The shares fell 4.2% following the results. The global ice cream market is forecast to grow 3 to 4% annually until 2029, and the Magnum Ice Cream Company is targeting 5% growth. They're hoping to trim around 500 million euros of costs through streamlining operations and supply chains. I think that should be absolutely doable. I think we covered Haleon last week, and if you look at the amount of costs Haleon have been able to trim from when they were spun out from Glaxo, I think Magnum can probably do the same, having been spun out from Unilever. I think these spin-offs, it's surprising actually how much fat is actually there with a lot of them, I suppose, because they were such a smaller part of the Unilever operation. And nearly 3/4 of the group's sales are from developed markets like Europe and the US, which I think makes sense. I think ice cream is more of a first world product, really. In terms of the valuation, business trades at a forward P of 16.2. That kind of compares to an average since listing of 14, but they only listed a year ago. Prospective yield is 2.7%. That compares to an average since listing of 2.9%. I think these figures are pretty good. I think the debt looks okay. I think the India acquisition makes sense. I think it's nice that the market's growing. I actually think I probably prefer, I know you've got concerns about GLP-1s, but the market is forecast to grow for the next 3 years. I think actually I quite like this business, and I think I probably prefer it to what's going to be left of Unilever in a year or so's time. So I actually, if it were me and I was holding Unilever and Magnum, I would be more inclined to keep the Magnum shares than Unilever now, I think. What about you, John? As someone who is in that position.
Well, yeah. I mean, I'm tempted to sell both, to be quite honest. I think bull case for Magnum is that they've still got a lot of emerging markets which aren't well penetrated, and there's a lot of growth potentially available there. However, what I do worry a lot about is the GLP-1s. And given that it's pure play ice cream, brands aside, and I appreciate they have got the best brands in the world, if the volumes do decline because of GLP-1s and heavy users in the Western markets, that's a big problem for them. And I could see it as costs of GLP-1s come down, as more people go on to GLP-1s, that starts to happen at some point. And I know that's not forecast in these numbers for the next couple of years, but it's a very rapidly developing market in the GLP-1 sector. So I would worry longer term. I think the valuation is fair. It's certainly not toppy, but I'd probably be looking to sell these shares. I don't have a lot of them because as a Unilever shareholder, you didn't get loads. It wasn't a massive part of the business, but I probably wouldn't be holding on to these for that much longer.
Well, seeing as you've got concerns about the population getting fitter, should we move on to a business that could be a beneficiary?
Well, yeah, we'll talk about JD. So they had their Q2 results out last week, with second quarter sales declining by 1.3% on an organic basis to £3.1 billion, and double-digit growth in Asia Pacific was more than offset by declines in the UK, Europe, and North America. And this was largely driven by their core customer demographic struggling with cost of living pressures, and their core demographic being 18 to 24-year-olds. Alongside the softer sales performance, elevated promotional activity is expected to continue over the second half, which is going to inevitably weigh in on margins. And as a result, full-year adjusted pre-tax profit guidance has been downgraded from 750 to 850 million to 7 to 800 million. And free cash flow guidance is maintained at between 460 and 520 million. £100 million of the ongoing £200 million share buyback has been completed, and the shares were down around 10.5% in early trading. In terms of valuation, the group have a market cap of £4 billion and trade at 7.9 times forward earnings compared with the 10-year average of 14.6, and they have a prospective dividend yield of 1.5%. I think you are seeing that there's a cyclical nature to this business. It is in retail, and with the cost of living pressures, particularly with that core customer base being between sort of 16 and 24, they are more vulnerable. They're not at that higher end where the earnings are much greater and it's not impacting on the discretionary spend quite as much. And it's interesting as well, because I've read some analysts who seem to feel that the sportswear industry is grappling with limited product innovation, which in turn is resulting in weaker demand and a subdued growth outlook. Not something, because I'm not really into sportswear, that I know a huge amount about, but it's interesting that that's what sort of industry sources seem to think. I think another problem is that North America, which largely accounted for the growth story with JD and accounts for about 35% of sales, has been struggling with increased competition. So I think that's also a bit of a worry. I think on the positive side, well, one, the shares aren't expensive, but also the direct consumer with the likes of Nike isn't progressing as Nike would like. And that does help businesses like JD. But I think all of this is reflected in that price at 8 times forward earnings. Would I be interested? Like you, Sam, I've been burnt in retail before, and I'd probably just be looking for a higher quality, more growth orientated business. And I've got probably too many worries in the fundamental investment case with JD. So not one for me, but I can see why some people would be taking, well, a deeper dive into this, that current valuation.
I think it's interesting because we obviously covered the business for a while. About a year ago, I think really going back to kind of April 25 when sort of the tariffs were at their peak. But I remember we looked at it and it was at a PE of about 5 or 6 and it did stay there for a while. When you look at the share price, it's actually not dissimilar. I think the share price has gone up a bit, but it's really because those earnings have dropped off. So the market, I think, was actually doing quite a good job at being forward looking there. I think you could do a lot worse. I think it's a decent business. I'm not sure I really understand the point about innovation because I don't see how you innovate a trainer. Yeah, we've tried everything. We've already put wheels on them. What more can we really do? I'm a Nike shareholder and I'd much rather just hold that because I feel like you've almost got that really high quality brand to fall back on. Whereas with JD, it's just so reliant on those relationships. And whilst, as you've said, like the direct consumer's not done that well for Nike and Adidas in the last couple of years, and those relationships with sort of companies like JD have become increasingly important, I don't think it changes the long-term direction the big boys will want to go in. So yeah, I think longer term, I think if you wanted exposure to it, well, why do you need the retail element? Because you could just buy Nike or Adidas. So why do you need the retailer? And although it's a very well-run retailer, it's just, I just wouldn't be interested because of the industry, despite how cheap it is.
Fair enough. Okay, on to Coca-Cola Europacific.
Yes, so they're also UK listed. We have covered them before, but we do tend to give more focus to their Hellenic cousin, Coca-Cola Hellenic. So Coca-Cola Europacific, for anyone who's not familiar, because I think we've uncovered them once or twice before. They have the license for Coca-Cola, so they do the bottling and the distribution, and they mainly do it in kind of Western Europe and Australasia. So I'll quickly run through their markets, of which there's 31. But it's Andorra, Australia, Belgium, the Cook Islands, East Timor, Fiji, France, Germany, Great Britain, Iceland, Indonesia, Kiribati, Luxembourg, Monaco, Nauru, Netherlands, New Zealand, Norway, Papua New Guinea, Philippines, Portugal, Samoa, Solomon Islands, Spain, Sweden, Tokelau, Tonga, Tuvalu, Vanuatu, and Wallis and Futuna. So basically, it's kind of Western Europe and Australia is probably the easiest way to think about it. And they have come out with their half-year results, and volumes were up 5.6%. Revenue was up 4.4%, 10.7 billion, and all these figures are in euros. Cost of sales was up 4.5%, 6.9 billion. Operating profit was up 6.9% to 1.49 billion. Earnings per share was up 9.1% to €2.17. Revenue per user, that was €5.34, and cost of sales per user was €3.46. If we break them down by segment, of which there's basically just two, so there's Europe and then there's Australia, Pacific and Southeast Asia. In Europe, volumes were up 5%, revenues were up 5.9%, and operating profit was up 3.7%. And in Australia, Pacific and Southeast Asia, volumes were up 6.9%, revenue was up 0.4%, and operating profit was up 18.4%. In terms of the split of the revenue, most of it comes from Europe, so that's 7.9 billion, and that compares to 2.8 billion from Australia, Pacific and Southeast Asia. They've reaffirmed their full year guidance, which was revenue growth of 3 to 4%. They have highlighted there's 6 extra days in Q1 compared to 6 fewer in Q4. Cost of sales, they expect that to go up 1.5%. Commodities are hedged for approximately 90% of the cost for the year. Operating profit, they expect to grow 7%. CapEx, they expect to be 5% of revenue. And they have a dividend payout of 50%, which they're going to maintain. And they have a share buyback of 1 billion for the year, of which 593 million was complete by 31 July. So for that 1 billion share buyback, for context, that is on a market cap of about 35 billion. So it's a few percent. If we go into the categories, so I think the two I'm not going to go over every category, but the two that I think are interesting are other, including energy, because for Coca-Cola HBC, the energy's been bombing away, and water sports, ready to drink tea and coffee. Because again, for Coca-Cola HBC, Costa's actually been doing really well. So if we start with water sports, ready to drink tea and coffee, so that was up 9.5% for Q2 and 5.6% for the half. Sports was up 12.1%, and that was 18% for Q2, driven by continued growth of Aquarius in Spain. Powerade grew double digits, driven by great FIFA World Cup activation. Ready to drink was down 3.1% for the half and up 1.9% for the quarter, with Fuse Tea delivering strong growth in Spain, offset by decline in Germany and Indonesia. And then for other, including energy, energy grew 18.6%, driven by innovation. For example, Viking Berry and Ultra Blue Hawaiian, distribution gains, growth in multi-packs, and continued strength of original variants. ARTD momentum. What is ARTD? RTD is ready to drink. I can't think what the A will be. But anyway, momentum continued with the launch of new spiced, alcoholic ready to drink. New spiced rum, Bacardi and Coke, Absolute Sprite Pineapple, and new sleek cans. I'll just see if they actually have Costa, because they haven't mentioned it. Yeah, so they do sell and distribute Costa, which you would not know. I'll just search for it, because Costa was doing quite well as part of Coca-Cola HBC. They haven't mentioned it, so I don't think it's doing as well. So in terms of the valuation, business trades at a P of 21 and has a yield of 2.29%. However, you are getting another 3% through the buybacks. I think the price is pretty fair. I think it's a high quality business, but why would you pay it when you can pay a similar price and get Coca-Cola HBC? The growth's better. I think the countries are more attractive, because I think as well with this, Western Europe, it's pretty saturated. Australia, I imagine it's similarly saturated. And then if you look at those other markets, it's basically just kind of Australasian islands. If they had some like big growth markets in Asia, I might feel a bit differently about it. But I think with those markets, there's not a huge amount in terms of growth to get excited about. So I would be picking Coca-Cola Hellenic every day of the week over this. That being said, it does look like a decent business. What about you, John?
For me, it's between this and Coca-Cola HBC, and I'd rather have Coca-Cola HBC. So it's an all right business, but when you can have a better one, which is same industry, but better run and more attractive markets, I'd go for that.
Shall we move on to Alibaba? How are they doing?
So Alibaba, I don't know whether it's been maybe even up to a year. It's been a while since we last covered them, but they had their Q1 results out last week with first quarter revenue up 9% to $39.6 billion, which was in line with expectations. And this was driven by e-commerce growth of 4% and high double-digit growth in AI, cloud, and compute services. Adjusted cash profit, EBITDA, fell by 30% to $4 billion, and that was largely due to technology investments, capital expenditure across the business. Free cash outflows more than doubled to $6.6 billion, driven by a sharp increase in capital expenditure on AI infrastructure to meet the growing demand. And the net cash position stands at $4.6 billion. $162 million of share buybacks were completed in the period, and the shares were down around 3.5% in early trading. In terms of valuation, Alibaba has a market cap of $308 billion and trades at 17.4 times forward earnings, compared with the 10-year average of 18.6, with a prospective dividend yield of 1%. I thought these results were pretty good. Adjusted cash profit fell significantly with the increased capital expenditure, which is very similar to the UK tech industry, but a lot of the big US tech players, with all of that investment in AI basically, and to meet the growing demand. I think the main issue with that is it depends a lot on how AI does play out ultimately, because in the near term, you're going to expect Alibaba to have to spend huge amounts to be competitive and to meet the demand in this industry. And you've got a lot of very big players also in the industry. I think the core business, and thinking about Alibaba as sort of the Chinese equivalent of Amazon, was very strong. But that being said, it's been a challenging time in the last 5 or so years, with the Chinese consumer maybe not having the strength that they did, and that growth and demand from there being more subdued. We've seen it with the likes of Burberry. That is a concern. And now it's that kind of AI play, and it depends what you think about that. It's certainly a lot cheaper than many of the US peers at 17.4 times forward earnings, although it's broadly, a little bit cheaper than it has been in the last 10 years. Other issues, if you were looking to invest in Alibaba, is that there's the large political risk. Depends what US-China relationships are like, and that's a big factor in it, and probably why it's again discounted compared with its US peers. I probably don't have the risk appetite for it, given those other factors. And also, if you're investing in it as a pure play, who knows where this sort of AI run is going. I suppose what you would say is that you've got some or a bit more protection from it, in that you're not paying really toppy valuations. But for me, I think probably a bit too much uncertainty, and I'd feel it was a bit risky. But I think overall, it still looks like a very good business. But yeah, not one for me. Sam, what are your thoughts?
Pretty much the same. Yeah, I agree. It's a good business. I don't think that's ever been an issue. I think if you go back 2 or 3 years ago, the valuation was really, really low. And I think it was the political risk pushing it down. It's a good company, but I just wouldn't have the appetite for it. I think you could maybe take a view that actually, what are we now, halfway through Trump's final term? If it can survive that, that probably would have been the period where you maybe would have been most concerned about it being delisted. So you might take a view, well, actually, it's probably going to stay listed. It's easy to look at it and compare the valuation, say a Google or an Amazon, and say, well, look how much cheaper it is. But I think the issue is that valuation is always going to be depressed because of that political risk. I can't see China changing how they're running their economy anytime soon. So I think if you look at it just based on the valuation compared to US peers, it's almost misleading, because you need to factor in that it's probably always going to have reduced valuation. Yeah, that political risk just wouldn't interest me.
You could think about a number of the Chinese tech stocks, and potentially, if you were willing to take the risk, take a basket approach with some of them and take a longer term view. But
then with the basket, though, the whole point of the basket is that you're de-risking it. But if they're all from China, I don't know if you actually, because I don't feel like the risk with Alibaba is actually company specific. I think it's because it's Chinese.
If you took the view that you think these are good quality businesses, although there is that large political risk, and you wanted part of your portfolio to have Chinese tech in it, you could buy a few of these companies, because I think Baidu is also very good, but have those as just part of the portfolio, almost like a little fund.
Yeah, I think I don't think I'd even have the bravery for that. I think I'd rather just buy an emerging markets index fund where it makes up like 10 or 20% of it.
Fine.
I think that would be as far as I would go with it. I just think with that basket, the problem is it's not going to be like if you get a pharmaceuticals basket, for example, whereas one has like a product or whatever, or a trial that goes well, that's going to do well. And, they're not all going to rise and fall at the same time. Whereas with China, a lot of the entire basket is just going to be driven by what's happening politically. So if you compare that basket to if you just had Alibaba, I think the performance wouldn't be that different. That's my
No,
concern with it.
It's an interesting point. It'd be interesting as well to go back and see historically how closely linked Baidu and all the rest of the Chinese tech stocks have done and how correlated they are. I can see why some people would be tempted.
Not me. Right, so of the 6 businesses then, Michael Page, BHP, Magnum Ice Cream, JD Sports, Coca-Cola Europacific and Alibaba, which do you like the most and which do you like the least?
Yeah, it's a difficult one. I would probably go for BHP because I think there is still a lot of runway in terms of further growth and demand for copper. And I think their quality in the sense that they're probably the biggest, they have the lowest cost, they seem well run, and I think they'll likely be a beneficiary. I think the difficulty and the hesitation I would have is where are you in that cycle? I think probably you may be towards the top, but it feels like there is further runway there. I probably wouldn't be going out with my own money and buying it, but of the companies this week, BHP would be the top. In terms of last, that's fairly easy. I'd go Michael Page.
So I think for me, top, I think I'd probably actually go Magnum. I do quite like it. I know there's GLP-1 concerns, but I do just think, well, that market's still going until 2029. It's hard because I'm not a heavy user of ice cream.
Yeah.
So I find it difficult to kind of conceptualize how much might actually drop off. But I think if it's still a nice day on the summer, people are still going to want an ice cream. But I think there is a risk there. Last, I'd probably go Michael Page. I think the industry it didn't seem like a great business and the industry didn't actually seem that attractive. I think Alibaba, I don't like the political risk, but I think it's probably the quality of the company is probably enough that I'd rather probably own it over Michael Page.
Yeah. On that note, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.